All right, welcome back. This is episode 2 of Health Further, where my partner, Vic Gatto, and I, we try to make sense out of this crazy world and relate it back to the healthcare industry.
Glad we made another week.
Yeah. We're, two down and 1,000 to go.
Yeah.
So today's show, we're definitely going to talk a little bit about some healthcare deal news, but there's going to be a lot of financial stuff we're going to cover today. So just a heads up on that. But I think we're going to start with a conversation about Amedisys. Amedisys had a big deal last week. Yet another big deal in the home health space.
Yeah. And there's been a lot of deals in home health over the last couple of years. Amedisys has been, I think, kind of struggling to keep up and catch up since the pandemic, really. But they got a big deal done this week.
Well, they were riding high. They were a high performing company leading into the pandemic,
Yes.
And then when the labor problems hit,
Right, exactly.
Yeah, that was a pretty difficult. Situation for them to navigate, but they found a home. So Option Care Health, which I actually hadn't
I didn't really know who they were, honestly. I had to go look them up.
But they're the nation's largest independent provider by revenue of home and alternative site infusion services. Interesting.
Yeah.
All stock deal, right?
Yeah.
And
so they'll be joining forces, and it's actually a pretty good combination. I think they'll be.
I think so too.
Able to help each other out.
Yeah, I think it makes sense. So let's just kind of take a look at Amedisys and how they have been performing here. So like we said, I mean, before the pandemic, it was a pretty good run up. And even, leading into 2021, that peak market cap of 10 billion, that's pretty impressive, right? That run up there. And then they acquired Contessa.
Yeah, and this management team had turned it around over a 5-year period from the depths of nothing. So they've done a great job building to that.
That's right. But then, I mean, it's been a rough run.
I was really surprised about Contessa. I mean, it was a startup here in town.
Yeah.
We know the team.
Yeah.
I love Contessa. I thought it was a good deal, but the stock market didn't like it.
Well, I mean, I think it was a big innovation deal, and I think what is interesting is it was a big innovation deal, but it was an innovation deal that didn't have as much sort of revenue underneath it, right?
Yeah.
You know what I mean? And it's a publicly traded company making this kind of acquisition. It was not a small acquisition. I mean, for a company at 10 billion, if you're spending 240,
right?
That's a pretty good nut, right? So
it was not accretive to earnings.
No,
it probably still is not accretive to earnings. It took a while.
And I mean, it's hard to knock. There's a pretty big downshift after that acquisition in terms of value creation.
Right.
And Optum and LHC gets announced, and so now we are at the Option Care sale. So I think this is pretty interesting overall. Vic, you pulled together this nice graphic that really shows over the last 12 months, home health has been the hotspot for acquisitions and mergers, right? Yeah,
I mean, I think it is the place where people have kind of put a bunch of chips. So you see. We had on the last slide LHC and Optum buying LHC.
Yep.
Of course, we're talking this week about Amedisys joining forces with Option Care.
Yep.
But it's been a trend. Humana bought Kindred at Home, and they rebranded it. So it's all Humana, but they've rebranded it CenterWell.
Yep.
Which is interesting. I think it allows them to sell to other payers.
Yes, of course.
More easily.
Another trend.
Yes.
The payvider trend, right?
Yeah. And then Encompass, which of course had inpatient, rehab, and home health, spun out their home health to have a more pure play. And both of CVS and Walgreens have really expanded into the home health in addition to their primary care.
Yeah, I mean, the Signify deal that's a big deal because it's like remote patient monitoring on steroids, right? I mean, it's like every single thing that's going on in the home, they're tracking. That was a very big deal. Was that $4 billion?
It was a huge deal.
I think it was $4 billion.
It was, but
I think it was $4 billion. That was a really big deal. And obviously Walgreens, with the VillageMD, hookup.
Yeah.
So I mean, look, there's a lot of consolidation happening in the home health space. I think it's tip of the spear, right, for these players. They recognize care moving to the home. It's going to be, a decade-long transition, but there's no question that if you're going to ever get value-based care, and I think it's also important to note that, Optum, Humana, into CenterWell, CVS, Aetna, right? So there's payers in the mix in half of these acquisitions.
Yes, there's payers and risk contracts everywhere on this page.
Right.
And I think you're right. You need home health for value-based care. I also think it's, people think about it as post-acute, you are recovering and you often need home health for a period of time. And that's certainly true. But I also think it sort of drives the referral patterns because as you start to build relationships with these people, they're often frequent flyers. Like they're going to come back again to the health system. And if you control that relationship, I think you then can direct it if you choose to, if you have all the assets. So a group like Optum certainly has everything wired up. But I think CVS and Walgreens and Compass and now Option Care and Amedisys sort of can do that same thing. Humana is probably more in the Medicare Advantage space. But so they're all taking slightly different approaches, but I think that's the kind of the.
So let's just riff a little bit about what you think this means for innovators like us, right? So we're in the venture space. We generally don't think many of our companies are going to IPO, right? So now you have a whole nother set of acquirers here in these home health. Sort of. Obviously the headline here is Humana, Optum, CVS, Walgreens. So really not new companies, but new capabilities, right, that have been created. And there's going to be a lot of needs for innovation that's going to happen here. Now, I think what's going to be interesting is how much did they learn from the past, right? So Amedisys and Contessa is sort of an interesting analogy, right? So are we going to see more of those types of businesses? There was a big move around hospital at home, but now it feels like we're thinking more about very specific, maybe disease states, maybe very specific risk contracts, maybe specific bundles, maybe specific, payer mixes and models. What do you think is going to be the
as a VC or as a small high growth company? I think it's really important to focus. So focusing on a disease state or a particular population type, like maybe Medicare Advantage and cardiac care, really allows you to focus in and get very good at what we used to call disease management. But now I think it's sort of the entire kind of length of care across, leaving the health system, that whole recovery phase, but then ongoing, making sure that they stay healthy. And if they need to go back, then you direct them to the right provider. I think these groups are going to be interested in those kind of focused niche plays, and they have now the breadth to sort of buy up several things that we build.
Here's another angle. I don't know that much about Encompass Health, but the rest of them, even Humana, because CenterWell actually, I believe that brand was really a primary care, urgent care brand that's now been expanded to the home health, right?
It's an urgent care for seniors,
right?
I think.
Right. Okay. So I think another thing is, Optum obviously has Optum Care, but CVS and Walgreens clearly are in the primary care, urgent care business, right?
Yeah, and Oak Street was a big play to that.
Exactly. So there's also clearly something going on around that primary care loop, right? So not necessarily everything thinking about, discharge and post-acute, but like just general well-being, right? And even with the option care, right? You're talking about, infusions.
Yeah.
Okay. You can add phlebotomists to that. And now, you've got something that can be more of a consistent wellness platform. Thinking into the future, obviously, thinking 10 years, not necessarily what we're going to be doing today.
I think that's right. Whether you start in a primary care setting or you grab them post-acute and then sort of bring them over to have a consistent care. It used to be called medical home. I hate that term. Who is the point of contact that I always call when I need help?
Right.
And I think all of these brands are looking to do that. And you enter through different doors. I think there are people that have I have a primary care doc that is my go-to person, but there's a lot of people that don't have that.
Yeah, but you and I are Gen X.
Yes.
And
so I think you might be able to grab people after they have a new knee and they have a ton of rehab, a lot of home health they need. And then you can sort of pull them into the system kind of through that door. But either way, you want to get a long-term relationship and kind of steer that patient, one, to be more healthy, take better care of themselves. But I think also with all of these payer-focused now providing services, steer them into our universe. Right?
So last question. Do you think that this overall accelerates value-based care?
I don't know that this accelerates it. I think it has to be, well, I guess it accelerates it. I think it's still pretty slow.
Yeah, agree. Yeah. So
maybe it accelerates it, but from a slow base.
What's the pace of acceleration? Right. Yeah. Agree. Okay, awesome. So good discussion. Something we'll need to be watching over the next year, I think, really see what ends up happening, because all the pieces are now off the chessboard. I mean, Emeticis and LHC, those were the big ones.
Yeah.
And they are now embedded into other systems, right? And so it's going to be interesting to see how this all plays out.
Yeah, there's another group of what I'd call regional home health groups, but they're not nationwide. They don't give you a entire swath of the country like Emeticis did.
Right. All right, so we're going to go to our first break, where we're going to have our first sponsor, which is ourselves.
Yeah. It's a friendly sponsor.
Yeah. Tell you a little bit about Jumpstart Foundry.
I want to take a minute to talk about our investment vehicle, Jumpstart Foundry. It is the product that Marcus and I put together first. It invests in pre-seed companies at huge scale, 30, 40, 50 assets a year, every year. Jumpstart Foundry invests in across the U.S., the best and brightest entrepreneurs that are really making a difference, making something better in healthcare. If you listen to this podcast, you hear all the challenges, everything we're facing in healthcare. Bottom line is we spend $4 trillion a year and we don't get great outcomes. Jumpstart Foundry allows individuals for a very small minimum, $25K, you can come in and get to deploy that capital across the entire portfolio. You get immediate justification. There are no management fees, super easy to get involved and really make a difference. You can have an impact. Come learn more at www.jsf.co. That's Jumpstart Foundry. Thanks for listening. Now back to the show.
All right, we're back. So next we're going to move into sort of a non-healthcare specific topic, but obviously we're going to loop back into healthcare, which is to talk about productivity. So the Bureau of Labor Statistics on Thursday, May 4th, when we recorded the last show, had their release of productivity numbers. And I think the headline is pretty scary, which is for 5 consecutive quarters, year-over-year declines in productivity. And it's the first time ever that this has happened going back to 1948 when they were collecting the data. Have we had 5 back-to-back quarters of decreased productivity?
We've never seen that much or that little productivity.
Yeah. So this graph here, the gray in this graph is output per hour. And you can see it does on occasion in certain windows, not often, but on occasion it goes down. This is actually pretty remarkable that our country has had such consistent productivity growth.
I mean, this is what's great about America.
Yeah, it's incredible. Yeah. When you really think about it in the long view, from 1948, that's an amazing chart. But
and the 70s were a hard decade.
For sure.
And that's when we had productivity.
That's right.
Struggles.
That's right. So are we in another hard decade?
Yes.
Yeah. Five back-to-back quarters. Yeah. And look, there's also something I think pretty interesting, and it seems to be a bit of a pattern. I mean, I guess this was in 1970 or something like that, maybe. But the growth of the cost of the unit of labor versus the output per hour, there's a dislocation between those two things, right? Which is when the cost for labor just kind of skyrocket for some cataclystic reason.
Inflation.
Right?
Yeah.
You end up getting this decrease in productivity. So there is some relation there we can see over time.
Yeah, I think the parts that I would put is like in the 90s here, you have people are earning more money, but also productivity is going up.
Yeah.
So the internet, there's lots of big advances in productivity through technology. And in the 70s, you have huge inflation and several quarters, although never 5 in a row, when you have declines.
Right.
And so it's not a good sign. I mean, maybe it'll turn around, but it's not a good sign that we have very high labor costs and declining productivity.
Yeah, it would be interesting to kind of go back and see where we had these significant decrease in the costs over the last 20 years, whether those related to globalization, related to technology. It would just be interesting to see what drove those particular things. 2008, this could
I think those are recessions.
That's a GFC, right?
Yeah, that's GFC.
Yeah.
I think that one is maybe a recession in 01, like the .com.
Yeah,
I think
probably.
that's what it is.
Probably, yeah. Yeah. Okay. So that's
we should probably just, for the audience, talk about productivity, because I had to go look it up to make sure I knew what the hell I was talking about on the show.
Yeah. So the definition of productivity in economic terms is productivity is a measure of economic performance that indicates how efficiently inputs are converted into outputs. So it's an efficiency metric.
Yeah.
And you've basically posited that the economy can grow in three ways, which I've got listed here. So I'll just read it off, and then you can kind of go through them.
Right.
One, more people in the workforce.
Right.
Two, more raw materials, energy, wood, plastic, et cetera. So that makes a lot of sense.
Yeah.
And then third, more productivity through technology or new methods of production.
Yeah, I think those are the ways that GDP, like our economy, can grow.
Yeah.
And the best of those is productivity. Because otherwise it's hard we have to have babies, and we're declining.
We're declining
population.
Yes.
It would be great. I mean, immigration or other ways we could but that's kind of stealing from other countries. Finding new raw material
has its
limits. There probably aren't many new sources of energy or other raw materials that we haven't already found.
Not those that wouldn't come out of technology, right? I mean, so
yes, technology would enable maybe a new support source or something.
Yeah. How you would leverage the weather, how you would leverage solar or wind or water forces, right?
Yeah. So if we put a bunch of solar installations in, and we had very cheap cost of energy, at least on a marginal basis,
right,
then you would have economy growth, and it would be great. So that would be an example. You get more raw materials, but through the technology of then implementing solar.
Right.
So I think it's not a good sign that productivity is down. That's why it made headlines. That's why I think it was worth bringing up. Yeah.
So let's now relate this back to healthcare. So there's an MGMA study that came out beginning of May, and this is largely physician groups contributing to this survey, and they're just talking about staff shortages are draining productivity among their team.
Yeah. So I think healthcare is not immune to this. It might be worse than the overall economy. There's a shortage of workers. We don't use technology tools. I don't think any of us would say that healthcare is super efficient at using its inputs to help people. It's just not efficient, and it is trending with the rest of the economy.
Yeah, and it's we talk about this a lot in healthcare circles, but it is a different kind of industry because it is 50% paid for by the government, which means it's got all sorts of government incentives and regulatory capture embedded in its economic model. And, look, it creates a lot of jobs. And the government likes to say that it creates jobs. That's like one of those important metrics that it has, right?
Yeah.
And so like when you think about all the different, just the web of incentives and who's scratching who's
back. One way to create jobs is to be inefficient.
Exactly. Right? Exactly. And you can do that through regulation, right? Yeah. You can say we must have a person sitting here to do this thing instead of a piece of technology.
Yeah.
Right?
Yeah. that CMS is trying to push that out right now in home health.
Yes.
We have people doing work. We'll talk about that in a minute with
Right. So this is this productivity issue, which is not a healthcare specific issue, which is an overall U.S. economy issue, is going to be really, really pronounced in healthcare because of our dependence on the labor force, because we are a very inefficient industry when it comes to that third category of productivity, which is leveraging technology, leveraging innovation, finding new ways to lower the cost of a labor unit, right?
We don't run well, but from an optimistic point of view, that allows us to make gains.
Yes.
If we just get our act together and begin to be more efficient.
Right.
Healthcare has more room to run on the productivity front than maybe other industries.
A lot more room. Room. It's really not a matter of the room to run. It's really a matter of the will. It's a matter of the will. Yes, exactly. All right, and I think that's a good time to shift to the CPI because this is definitely going to be the storyline until we get this under control around all things. It came
out this week.
Yeah, so, and it's a driver. We should just at least explain that inflation impacts the cost of labor, right? And so that it's feeding into this overall productivity conundrum that we're in. So we just had a print this week, and we came out at 4.9, so that's good.
Yeah,
Ish.
Slightly better.
Yes, it's a good ish, right? We're a little bit down, but that durable portion of it, if we can look at this graph here from CNBC, the durable portion remains pretty consistent. It remains durable, right? The services component, the non-commodities piece of inflation is not really going down. So what do you think is going through the minds of the Fed as they continue to increase the rates and they don't see this part?
I think they're still worried about inflation. Like energy is going down, oil is going down,
right?
But that's not going to get it all the way. They're really looking for it to be 2%.
Yeah,
and we're more than double that.
Yeah.
So I think they're still going to stay. Hopefully, they'll stop raising, but I don't think they're going to be cutting rates anytime soon.
Yeah, and that's going to set the stage for everything else. So this is probably a pretty good time to shift to our health further friend, Emily Evans, who is the health policy leader at Hedgeye, and she's going to walk us through a great conversation on the Chevron Deference Doctrine. All right, here in studio, we've got health further friend Emily Evans, who is the health policy resident expert at Hedgeye. Emily, can you tell the listeners and the viewers a little bit about Hedgeye?
Yeah, Marcus, thanks for having me today. Hedgeye is an independent research firm. We focus on all areas of the U.S. economy and parts thereof. My particular specialty is health policy and healthcare, and I am a translator and a tour guide for investors and people in the industry.
You slacked over a pretty esoteric topic, but we thought it was worth covering because I think there are some implications for the future of healthcare innovation and entrepreneurship. So we're going to talk a little bit about the Chevron Doctrine today, right?
It's technically called the Chevron Deference.
Okay. All right. See,
we're learning already.
Right away.
Let's talk a minute before we get, and nobody fall asleep quite yet, because this is actually pretty interesting. On Thursday of last week, CMS made a proposal, just a proposal, not finalized, that says that for home and community-based services, which is a growing area in the Medicaid program, it's a growing area because states went, it's not great to keep our IDD populations or our dual eligible populations institutionalized. We should have them served in a more of a community setting, less institutional, more of a home setting when possible. And so a lot of states have moved those populations into home and community-based services instead of having them institutionalized in, say, a long-term care facility like a nursing home. The proposal from CMS said that all Medicaid payments that companies, businesses that serve the home and community-based services component of Medicaid, their vendors to Medicaid, would have to spend 80% of their Medicaid payments. States would spend, when they pay the vendors, 80% would have to go to compensation. That would leave 20% for SG&A, margin, et cetera. This is, as far as I know, never happened before. Never has CMS said, oh, yeah, let's say, here's what your margin is going to be. The exception, of course, being the insurance business, where they set, minimum loss ratios for certain insurance plans. But you don't have them say, okay, the margin for home health care should be 15%. This is never done it before. And one of the reasons they felt they could do it, there are a lot of political considerations in there, which we can get into, but one of the reasons they felt they could do it is because of the Chevron Deference Doctrine. Now, okay. Do you want me to tell you what that is?
Yeah, I do, but I want to just make sure I'm understanding like the big issue here. So it sounds like the big issue is that we have an agency that is acting under some level of authority to set margins in a really, really tight labor market for the segment of the market that, we're hearing a lot of people talk about. Home care, people with high specialty needs, sort of an area where you may have challenges finding providers, and now we're putting some level of capitation on that market. Am I basically understanding that correctly?
It's not so much capitation as because what you're saying here is, no matter what the government is saying here is, no matter how tight your labor market is, no matter how much you have to pay people to work in home and community-based services, 80% of your Medicaid payments would have to go to compensation. So that means either you pay people more or you pay more people or some combination of both of those things. And if we focus in, you just said something important, which is CMS under some authority is doing this. Okay. And that's the trick. When an agency, as CMS has proposed here, makes a proposal like this, and please understand, this sort of action is very nonpartisan. Every president since really Obama has engaged in this kind of pushing the envelope of that regulatory authority. And what CMS is doing here under the direction of the White House, because we haven't seen a ton of policy saying, oh yeah, this is the direction we're going in. We've seen some political signals, but the mechanics of policymaking really had not brought this topic up until it landed on Thursday, which is why, it sent the stocks flying, and I'm sure created some heartburn in the private sector. But the real question is, do they have the authority? And I think a lot of people listening to this and a lot of people on the street think, oh, well, they're the government. They have the authority. Yeah. Sure, government could do anything, which isn't really true. But it's more true and has been more and more and more true every year since 1984, when the Chevron Deference Doctrine was adopted by the Supreme Court, and the opinion was written by Chief Justice Antonin Scalia. And it's been slowly evolving into more and more stretches, if you will, under that regulatory authority or under that legal authority you mentioned earlier.
Vic, yeah.
Yeah, so I want to just dig in to make sure I understand the issue, because if it's as I understand it, it's really going to be damaging. I think it is. The stock market has been behaving this way. I think if you are bound to pay compensation equal to 80% of what CMS reimburses, that does not allow for technology innovation or the ability to use tools, data, better practices to gain an advantage. It's basically socialism, or allowing like every competitor is going to have to be the same, basically, using all human labor. It's like the unions are taking over our healthcare. And I'm in favor of people delivering care in the home. I think that's needed. But I also want to reward companies that maybe create a new technology and could deliver better care with fewer people and have profit for investors. It seems like anti-American to do this.
Well, and there's been conservatives have really led the charge on this kind of creeping authority from all agencies. And actually, the Supreme Court accepted a case just a couple of days ago. It has nothing to do with healthcare. It's about fishing. Okay. But they accepted a case that actually challenges the authority of Chevron Deference, which challenges the authority of CMS to even do this. So, in fact, from the justices' point of view, the four that voted in favor of accepting this case, from their point of view, you're absolutely right. They're saying, oh, wait a minute. If you're going to adopt a specific margin for a specific area, that's really something Congress probably has to do, and would have to do it after all of the usual deliberations. It's not really something an agency could do. At least that's the way I think that it will eventually evolve, because we've been seeing signals that the Supreme Court is not like Chevron deference at all. And there were some fairly big reaches during the Trump administration, particularly in that 2020 period, that have all been shot down by the courts, not because of the Chevron deference, but kind of coming up pretty close to that. So your perception's right. How can this be? And the answer is because of politics, and politics overriding the policy mechanism, because a policy discussion would identify almost immediately the problems you just cited. Where's the innovation going to come from? Where's the technology? Where are the people going to come from?
So, can we just talk about how this may have historically shaped healthcare the way that it is today. Because as you've said, we all just, when something's been happening for several decades, we just sort of build it into like that's just the way it works. But since it is based on this case from Scalia, as you said, what was it, 80s?
1984.
84. Okay.
And remember, Scalia was conservative justice, right? This is how times have changed.
Yeah, totally. Yeah. So, what are other areas where we may be seeing the important healthcare agencies, leveraging this doctrine, in ways that could be questionable or, could have impaired the healthcare industry's ability to innovate up until this point? Is there a way to sort of look at certain things and be like, that probably was because of, the Chevron Deference doctrine?
Well, exactly. So, what the Chevron Deference doctrine suggests is that if Congress has not explicitly prohibited something, they haven't come out and said, okay, do not do that terrible thing, and it's reasonable what the agency is proposing, well, then you should defer to the agency. Okay. In the case of the CDC banning, putting a moratorium on evictions during COVID, the court didn't even review the Chevron doctrine because they're like, that's not reasonable. It's not reasonable to say people can never be evicted because it might create a homeless crisis that you don't have any work done. No. So in the context of healthcare, this doctrine has allowed the agencies to dictate, and I've heard investors say through the stroke of a pen, certain activities that they like or don't like that don't have political support, by which I mean congressional support. A great example of that was the Trump administration came up with this, and I know we don't want to use a lot of statutory citations like 340B, but most people listening to this probably know what 340B is. It's a drug discount program. And the Trump administration kind of reallocated revenue from that. It had absolutely no statutory support for that. And of course, courts eventually said no, again, not getting to the Chevron deference. Where it gets iffy, take a law like the Affordable Care Act. And remember, Barack Obama really frustrated because he couldn't get through Congress. Congress, this is when the wheels really came off on Capitol Hill. And he wasn't getting anything done. He had really used all of his political capital on the Affordable Care Act. So what does he say? I'll use my phone and my pen. And that was his, I'll just direct these agencies to do what they need to do. And they did certain things that I think our industry would go, okay, that's great. Like suspending certain, risk corridor repayments during the Affordable Care Act because risk profiles had gotten so haywire and so bad for the insurers. I think our industry would say, okay, that's good. In the case of the Trump administration and the 340B program, you took a big old sledgehammer to some of the, revenue models for nonprofit hospitals. And that, I think what most people would say was not good because, there was no notice on it. So it's always been part of it. It's just really ramped up since the Obama administration. And now we're in this kind of tit for tat. Well, Trump did it, so we can do it. The Biden administration can do it. And Trump said he could do it because Barack Obama did it. And it's just sort of devolved from there. But this proposed rule that says home and community-based services, you have to take 80% of your Medicaid payments and use it for compensation. That's just another devolution, if you will, of using the bureaucratic system. And there's tons of others. The way in which home health has been, home health has been a redheaded stepchild of the CMS for years. And no offense to any redheads, but it's been and so it takes a lot of abuse in terms of coding changes and so forth. There's also like this rules in Medicare Advantage. it's stuff that doesn't make the front pages. It's really material to the operations of the industry. And now we've seen this home and community-based services rule. It really is kind of extended into a new level.
So, I mean, I think it is really a sign of the dysfunction of our national government, right? It's supposed to be that we have three different branches of government: legislative, executive, and judicial. And this is, in my view, this is the executive division trying to grab power from the legislative body, which is pretty incompetent. And so whether I agree with the ruling or I don't agree with the ruling, it would be better to have the three branches be functional. But
you're exactly right. And Vic, one of the reason this has happened, the reason the federal government has leaned deeper and deeper into the bureaucracy is because you can't get anything done on Capitol Hill. And the last bipartisan piece of healthcare legislation, I believe, was 2006 when Medicare Part D was approved as part of the Medicare Modernization Act. That was at 2006. And then you had the Affordable Care Act was passed on a partisan vote, through a reconciliation process, which is why it's still a pretty hot topic even today. And that was over a decade ago, that happened. So it's a function of that power struggle in Congress. And if you've been elected president, well, you want to get something done, right? You want to do something cool, and you can't, because what do you do is you bend that Chevron Deference doctrine into all kinds of pretzel shapes. So what if those justices they've taken this up, if they decide, and it takes 4 justices to take up a case, and they only need 5. If they decide that and they narrow the Chevron deference, or they actually toss it out completely, then what will happen, and I think this is kind of what you're getting at, what will happen is that Congress will have to do its job if it wants to do anything at all, right? Because it won't be able to lean into the bureaucracy. And you'll hear people in leadership, and they'll say things like, yeah, there's this conflict in this bill or whatever, but we'll let the bureaucrats figure it out. They actually say that. And now they won't be able to really say that if this happens the way I think it will.
So, Emily, I'm a little confused because, Vic was just talking about how broken our legislative body is, but, I think now our judicial body is pretty partisan, which it was never really supposed to be. And so, now as we're talking about the Supreme Court taking this up, and I think, are you, first of all, just 2 questions. One, are you implying that this case that has nothing to do with healthcare that they're talking about taking up right now,
about fishing,
right? This fishing case, that this actually has implications broadly to set precedent for the Chevron Deference doctrine first. And then the second question is, because it is a weapon that has been used on both sides of the aisle, depending on who is in power in the executive branch, what's the incentive for this partisan Supreme Court to eliminate it, before, there's a potential change in who's in the White House? I mean, it seems like it would be a pretty short-term view change to make, when it's pretty clear the House and the Senate are going to be broken for the foreseeable future. Like, that's not going to get fixed in the next 4 or 5 years.
Well, I think that when you think, I know and I understand, and particularly what's happened up on Capitol Hill today, that people view the Supreme Court as partisan, meaning R versus D or left versus right. And that's really not the way to think about it. The way to think about it, and remember, Justice Scalia wrote the opinion for the Chevron deference. He was saying at the time that we can trust the bureaucracy, these professional group of people who can, make these reasonable determinations. He's the one who started that ball rolling. The Supreme Court is kind of divided more between Federalists, and that's Kavanaugh, Gorsuch, as 2 of the most recent examples, and the more traditional group, that's John Roberts, who who was Chief Justice on the marriage. I can't remember the law, the marriage equality decision. And then there is because it's so small, we kind of lump them together, and that is the kind of progressive, liberal, traditional activist judges. Kagan, for example, Sotomayor, Breyer was in that group as well. Jackson has to recuse herself on this particular Chevron case because she ruled at the lower court level.
I don't think you mentioned Alito and Thomas. So where would you put them? Are you putting them in the Federalist
Thomas
bucket?
Thomas is a Federalist.
Yeah, okay.
I would say Alito too. I think it's easy, like I said, it's easy to kind of plug the R versus D thing, which I don't even think applies to politics, but but the reason the Federalist project to get judges on the lower bench and the appeals courts, that has been a project that's been underway for about 35 years. Mm-hmm. And you're seeing that emerge at the Supreme Court now. But that has been a concerted project for 35 years by the Federalist Society, and they've been quite successful with it. So when you think about it, you kind of reframe your mind a little bit. The Federalists are the dominant force on the Supreme Court, and as the dominant force, they believe in they are very much constructionalists. Keep the federal government out of it as much as you can, leave this to the states, whatever you can, and mind this creeping authority for the bureaucracy. That's how they're trained, and that's how they think.
But it strikes me that if they modify the Chevron Deference, is that what you said?
Deference, Chevron Deference Doctrine?
They need to draw the line somewhere, right? The administrative bureauccy is going to have to implement law.
Yes.
And so they where that line is drawn is what's under debate, right? So,
and I think that there's a very good possibility what they do is they narrow it, so it's not this wide open CMS right margin requirements for every healthcare industry in America, and it just gets narrowed, and that maybe that reasonableness gets defined more clearly. That could be a path that they take without tossing it over. Because you're right, in a normally functioning government, it's not a crazy idea to go, okay, the professionals do this all day long. Let's get them to interpret it. So it could just end up being, quite the narrowing of the doctrine rather than, ending it altogether.
Yeah, and that's probably where the smart money is landing, right? I mean, not on a total reversal or eradication, but like maybe a narrowing that maybe impairs the ability for CMS to do things like they just did. This 80% labor requirement.
Right, exactly. That's the kind that would be consistent with what we've seen out of the court over the last 15, 20 years. The John Roberts wing has been dominant, but now with the appointments of Gorsuch and Kavanaugh, and Thomas is now ascendant, you've seen that, kind of more of an incrementalism, taking little bites at different things, and that could very well happen. But the result will be the same, which is either the Congress is going to have to start legislating again and stop being so sloppy because the Affordable Care Act was a landmark bill and it was very sloppy. Or CMS is going to have to be less active and stick to what the law says, which is a good news, bad news story, because most of the Medicare and Medicaid law was written in the 60s. So there's a lot of stuff in there that's not particularly useful anymore.
Yeah, and I'm obviously completely biased, but my belief is that home health is going to be really needed. We should be increasing reimbursement overall and encouraging technology adoption and new innovation, mostly because we don't have enough home health workers. I mean, we're at a shortage. We can't find home health workers. So
yeah, that's pretty clear. Okay, we're at time. Emily, thanks so much. As always, you always make us smarter, and we will definitely be having you back.
All right, thanks for having me. That was fun.
All right, so that was fascinating conversation with Emily.
Every time I talk to Emily, I get smarter, and I get more worried about the government.
Yeah, she's really kind of one of a kind in terms of she was a local elected politician. She understands the finance world really, really well. She's working with some of the smartest people about macroeconomics and also Wall Street and hedge funds at Hedgeye. But she really is every single week. She's reading through these briefs and these new rules that get rolled out.
Hundreds of pages.
It's
but then
crazy.
She can relate it and explain it to us, which is great.
Yeah, which is awesome. So and we had that conversation not knowing that the Wall Street Journal was going to turn around and actually have a whole story about this
on that this week.
Yeah.
It's a big issue.
Yeah, for sure. All right. So let's now just shift into talking about what's going on in the banking world. We talked about it a little bit in the last show with the collapse of First Republic, second largest bank failure in U.S. history. And now potentially PacWest is in the crosshairs right now in the crosshairs. I think we just need to try to back up and explain what's going on in this space, maybe even for our own understanding.
What is the business of banking, and how can these big banks be potentially failing or already failing?
Yeah,
they can't all be mismanaged.
Yep.
So when the first one happened, people blamed Silicon Valley that maybe they did something wrong in their bond portfolio or whatever. Maybe they did, but now that we've had 4, there's a 5th one on their block. I just don't believe that they're all mismanaged.
Right.
And so I think we should just talk through the regional bank business model.
Yep.
And see if we can unpack what's happening.
Yep.
Just to learn what to expect, or maybe have a thesis of what to expect.
Okay, great. So I think the place where you want to start is what the asset makeup. What's the asset makeup of a regional bank?
Yeah. So the assets of a bank are largely loans, right? So the deposits are liabilities to them. Then they take that money and they make loans. And typically, I think most banks are doing pretty conservative loans.
They have to. We need to just say for a second, banks are incredibly rigorously regulated. There's been a lot of talk recently about, these banks are going, fast and loose.
Yeah, I don't think that's true.
This is not true, okay? Like, this is not what's going on in the banking regulatory environment.
When it was only one, you could maybe say maybe something happened, but I don't think that's true broadly.
That's right. Right.
So the basic thing they do is make loans to small businesses or someone that wants to buy a building or buy a piece of land.
Right.
And I learned this by trying to get loans. They're very conservative.
Yes.
And they typically are looking for 2 ways to be repaid that are conservative, underwritten. So it's not like a VC where they're hoping to get something. It has to be, you can pay me back and it's definitely going to work. And so if you just take an office building in downtown Nashville or downtown anywhere USA, there's rents. They have companies that are renting. And so the first way you could pay back the loan is you're getting rent in, and hopefully you don't spend as much money as you take in.
Right.
And then you can pay off the loan.
Right.
And that would be the first way. They wouldn't give you like growth assumptions, and they probably make sure that you put appropriate ideas about turnover of, they look at all the leases and everything. But in general, that's the first way, but that's not enough. Even when you have it fully rented, they still want a second payment.
Yep.
And so with real estate, that's the easiest one to talk about. They will take the rights to the building. So if you don't pay the loan, they take back the building. And they will not loan 100% of the value. Typically, they'll do 70, 75, 80% of the value. And so they feel very comfortable that, well, these rents are going to allow you to make payments. And even if you mismanage it and screw it up, we'll sell the building. And if it's worth $40 million, we will not loan you $40 million. We'll loan you up to 30. So we have a cushion there. And that's worked well for 50 years.
The reason why it's worked well is because there are generally really good regulations in place that set all sorts of criteria on what you need to do to evaluate the creditworthiness of someone to whom you're going to lend money to. The reason for that is that you're ultimately lending against depositors. That's your base, right? That's the base that gives you the ability to do this lending activity, right? And then you have all sorts of income coming in from the payments that are coming, and that's what the banking business looks like. It's this combination of depositors and your loans, and then the dollars coming in, and sometimes you're originating a loan, but then you sell it off as an asset to somebody else, right?
Very safe.
Yeah,
It should be very safe.
It's very regulated. I think just people need to understand this is not this like fast and loose industry, okay? Because as we're talking about bank failures and they're happening in such tight succession, right? It's important to know this is a pretty well-regulated industry. Okay, now.
Yeah, no, what they're not prepared for.
Yes, now we need to talk about why they're failing.
They're not prepared for anything changing fast.
Yes.
They can deal with changes in the interest rate, but it has to change over a long period of time. So Alan Greenspan or previous Fed chairs, they have changed the Fed funds rate, but they've changed it 25 basis points in the next 90 days. And they tell you that's coming, and then they wait for 90 days, they make it 25 basis points. Then it's very boring.
Right, right.
It's monotonous, boring. It should not, the Federal Reserve should not be a high drama place.
Yeah.
But unfortunately it has been.
Yeah. And we went through that in the last show. We showed the rate of change. We talked about how crazy that rate of change is, right? So and Vic, you're being a trooper fighting through this show. Okay, so let's now just talk through this 3-act play that we're in right now. We're in Act 2. So Act 1 was there were bond portfolios that were poorly managed, right?
Yes.
And that is what happened with SVB.
That's what happened with them, right?
Yeah.
They didn't manage their hold to maturity, and they're available for sale.
Yeah.
They should have managed it better.
Yeah, that was poor management. It was isolated to some banks. They were not the only one, right? And the reason we know they're not the only one is because in response to what happened to SVB, instead of just taking over SVB, they also created the credit facility, created a discount window
for anyone to do it.
For any of the banks who had these held to maturity bonds that were now underwater because of the interest rate changes, and said you can place them back. Okay, so that was sort of how they chose to address that one particular
SVB
issue.
also was modifying the regulations to give them more leeway in the bond portfolio, which they should not have been doing.
Yes, that's right. That's right. Okay.
Yeah.
Now we're kind of past that, right?
Yeah. That
we have the credit facility
play is over.
Yeah, we have the credit facility. So
it's in place. You should not. No one's going to fail from that. I mean, they would go to the Fed and fix it.
That's been resolved. Okay. So Act 2 is we now every week have to have a target.
Yeah.
Right? Every week, the short sellers and the media need something else to fixate on for each for their own reasons. But they need a bank to fixate on, and the media through just spinning up stories, whether it's through cable or through print, or short sellers in the hedge fund industry leveraging social media, they pick a weak target and they start attacking.
It's like the jungle.
Yeah. Yeah.
And I think there are weak banks. There's weak players in every industry. So that's always been the case. It's always going to be the case. What's different about this is because of the first act, which now has been fixed.
Right.
There's all this uncertainty and worry. And so the media or short sellers can take advantage of that.
Yep.
And I think they will continue to keep doing that. It's not going to affect strong regional banks, but there are banks that are, weak animals, and the wolves will take them down.
Yeah. Yeah. Okay. So then the third piece is this whole credit default issue surrounding the commercial real estate markets and everything that's going on there.
And just to be clear, the Fed, in my opinion, does not care about one-off failures because they are forced out due to a short seller or a media thing or anything. That's not a systematic risk.
No. And I don't even know that we're able to define systematic risk, but I think we can define what it's not. And what it's not is 1 or 2 or 3 banks going under because of pressure in the market. They don't
Right.
consider that to be a true financial system breaking, right?
Yeah, that there are other banks in those same markets that can provide loans, and so there's no shortfall in the system.
Yeah, yeah. So we are at what appears to be the potential beginning, meaning we're hearing more and more people talk about it, the beginning of the credit defaults. And that's much more scary than the act we're currently in, right? Because the act we're currently in, they got to kind of pick one target at a time. It takes, I don't know.
Hedge funds don't get together.
Yeah.
So they don't get their act together.
Yeah, that's right. There's no Schelling point where they can actually truly collude to get it done. But this other one, this is material, right? Because as the interest rates climb, that literally decreases the value of the underlying asset that is commercial real estate. Yeah. And that turns that business upside down in a very similar way that the bond portfolios were turned upside down.
Yes.
But in a way that is, I don't think you can call irresponsible, because it's fundamentally like this is the business model of
businesses.
This is the business model of regional banks.
Yes, that's what they do.
Yeah.
They make very safe loans with collateral.
Yes.
And if that collateral decreases in value, typically in the past, they have had a long period of time. The reason you want to be slow and monotonous is it gives the banks time to adjust, and they will come ask for more collateral. But it has changed so quickly that there are a lot of commercial buildings that are not worth enough to cover the debt. And so that's the potential for this third act of it, which I'd call it a credit event, where many people that own buildings and have debt will decide to not pay the debt and give the keys back to the bank because the building's not worth what they owe.
Right.
And so it's better for them to give it back to the bank. And the bank can't manage it, and they also can't sell it.
How does this all relate to healthcare?
I think that's going to happen in the next 3 to 12 months.
Yeah, and why do you think that's going to happen? I mean, I think there's real data around this, right?
Yeah, so there are loans that have to be refinanced, that are coming due.
Right.
And they have to be paid off or refinanced. Normally, you would refinance them.
Yeah, and the number of those loans?
I don't know how many, but it's $450 billion in value.
By value.
Yeah, so those loans, I don't see how they can get refinanced, period. And so that's going to be a real problem. The reason it matters to healthcare, or anyone really, is the Fed has to make a decision. Are they going to do anything? And if so, what?
Yeah.
And I don't think they can create a facility where they accept all of these buildings, because that's not an asset that they can hold. I don't know if they're allowed to hold a bunch of buildings.
Right.
And I also don't know how they would go about that. So taking back treasury stocks that are underwater, they make treasury stocks. They have treasury bonds. They know how to do that. I don't think that they're going to create a bailout like that for commercial real estate.
Doesn't really seem like it's possible, because they're not the producer of the underlying asset. So like their ability to sort of back it out, just kind of collect it. I mean, they could, the Fed can always just buy a bunch of assets. I mean, isn't that kind of what happened during the credit default swap issue in the GFC? I mean,
Yeah, they created.
They did, right? They bought a bunch of.
Well, they like grouped all the shitty assets in one thing, and then stood up and I think another and to buy it all.
Yeah.
Yeah. So whether it's the Fed or Treasury, they would have to work together and do something. So they could figure something. I mean, the federal government can figure it out. They can figure it out.
They can figure it out. But it's not insignificant, right? I mean, if it happens,
it's a lot bigger of a problem.
Yes.
This is just the $450 billion is this year.
Right.
You'd have to do it for other years.
Yes.
And I think that would be very inflationary.
Yeah.
Or they could reduce rates fairly dramatically to 1 or 0.
Which is what happened the last time.
That's the more likely scenario. And that would reverse all the asset prices.
Yes.
And fix the problem.
Yes.
But then it would have a secondary effect,
Right.
which is it would drive inflation.
Yes.
And
Which is already durable.
which it's still on the screen. It's already durable. It's already at 5%. So it would go back to 8, 10, 12, whatever.
Yeah.
And that is, I think, a real problem for healthcare,
Yes.
because healthcare systems do not get to set their price every day.
No.
In a pizza place,
They cannot respond well to.
You can change, the price of your inputs go up. You can change the price of what a large pizza costs.
Right.
Health system can't do that. They are stuck. Once a year, CMS comes out with new rates.
Yep.
And almost all the payers tie to that.
Yep.
So it doesn't really, almost 100% of their revenue is largely fixed until the next year. And I guess in theory, CMS could raise their rates significantly, but they never have, because we have as we heard from Emily, we have challenge in DC, and I just don't see how, with the debt situation we have, they're going to do that.
So we're either in a situation where we let the banks suffer. Let's not go so far as to say fail, but we let them suffer, right? And that's going to be a pretty significant issue, because look, these banks are in one way or another underlying financing that the healthcare industry depends on, right? I mean, and especially regional banks to regional health systems, especially like that particular segment of the industry for sure. And that's going to be bad. If the Fed steps in and says, okay, enough, we now consider this to be a break, so we're going to, bail everyone out of the CRE issue, and
whichever direction they take,
and probably pivot on rates, right?
Yeah.
That's good for Wall Street. That's good for a lot of equities.
Yeah, it's probably good for our selling thing in our portfolio.
Yeah, it's good for venture.
Good for venture guys.
Yeah, good for venture funds. But it's inflationary, which relates back to the productivity issue,
right? Which
relates back to labor costs, which health systems in particular cannot adjust fast enough on. Right?
That's right. I mean, the pandemic drove inflation. And all of a sudden, you could get a job at the pizza place and make a lot more money than you were in the health system, and it's an easier job. And healthcare is just not designed for changing their costs that way.
Yeah.
And so it is going to be damaging to everyone if this default credit crunch default thing is what I fear it is. But it's going to then flow to the banks and then to the health system. And
by the way, let's just overlay that with everything Emily just told us about what
how
CMS is.
Yeah.
Well, no, but specifically about CMS and sort of the labor requirements that they're pushing in terms of percent of what you're going to spend on labor, and then overlay that with the home health acquisitions. I mean, it's
all intertwined.
Yeah,
I mean, that's why I was excited about doing this podcast, because all these issues have connection to each other, but we don't get to spend enough time pulling it apart and really examining it.
Yeah. Yeah. So unfortunately, I don't think we're going to leave on a clear note of.
I don't have a good answer.
Yeah. I don't know what to do about it, right? But I do think it's important for us to understand these things that are happening in the banking world, these things that are happening in the overall universe of productivity, the CPI prints that are happening. They're not divorced they're certainly not divorced from the healthcare system. And we as innovators, we're like bottom of the barrel in terms of like who cares about the venture folks.
Yeah.
But it's really important that we, the innovators, the founders, the investors, we're tracking all of this stuff so that we can understand where are there going to be needs for innovation and where do we need to be placing capital? But B, also, what are some of the pressures that the healthcare industry is likely to go through so that we can maybe anticipate slower sales cycles, lower budgets, availability, maybe a shift in dynamic power between one segment of the industry to another segment of the industry. I mean, these are we're in the middle of something really, really significant, right? Those 5 quarters of back-to-back productivity decrease, that's
really bad.
That's bad.
The way out of this for the system or for one individual person or one company is to figure out a way to be more productive.
Yes.
And I think we're biased because we are innovators and investing in innovators. And that is typically meant to make people and systems more productive. It doesn't have to be with a venture-backed company. Any way you can find a little more productivity from your team or your company or in your own career, that will prepare you for this coming challenge. But I don't know if we're going to be able to do it quick enough.
All right. Well, we got to try. So I think we've covered a lot today, but great show, man. Thanks for fighting through it.
Yeah. Hopefully I will not be coughing and suffering.
Yeah, next week we're not going to be in the studio because I'm going to be traveling. I'm going to be in Aspen for an executive seminar with the Aspen Institute. So we'll be doing this remotely from my room in the Aspen resort. So hopefully the Wi-Fi is good enough to hold up for a quick conversation. But we will be back next week with episode 3.
Yeah, excited to do it. Hopefully we will not have any bank failures, and we'll be talking about something else more fun.
Yeah. Hope so. So until next week, thanks for hanging with us, and we'll see you next time.
Thanks, everyone.